we've been tracking the yields, obviously. We've been talking about that for a while. Any sign that there's any change in that relationship, or what sort of levels or triggers are we looking at right now?
Well, there was some hint that the connectivity was breaking down yesterday, but then it came back and reasserted itself later in the day. I think they're trying to figure out where they want to go. You get the sense, as you discussed with Kenny Polcari earlier this morning, that the temptation is to think we're going to retest some of the recent lows anyway. And that would be a very healthy thing for the market. And so far, the Twitter account has been reasonably quiet.
Oh, no, you're speaking too soon. We got a Fed tweet from the president, Art, as you speak. Our Federal Reserve cannot mentally keep up with the competition other countries. At the G7 in France, all of the other leaders were giddy about how low their interest costs have gone. Germany is actually getting paid to borrow money, 0 interest plus. No clue, Fed.
But that kind of tweet is relatively harmless. He can abuse the Fed all he wants. What will spook the markets is if we get into trade talk again. So if he stays away from China and trade talk, that's kind of a benign background to where we are here. So if there were any further weakness, I would be watching the area down around 28.34 and then finally 28.22. And if we test or come close to that and hold, I think that will give the market a sense that they've cleared another hurdle, and maybe we can get back to an honest rally here.
It's about 1.5%, 2% down from here, right? So we're kind of skirting this this sort of decision point, I guess, in terms of the trading range. I mean, the president's tweet, yes, it's a reiteration of the case he's been trying to build toward the Fed for a while now, but we're in this, 3-week window or so before the Fed actually meets. What do you think is baked in, not just for what the Fed's going to do, but whether they can sort of get ahead of this cycle that we've had here of they cut and the market asks for a lot more?
Well, the market's asking for a lot more going in. And you've heard several economists here on this network say that they really should do a 50 percentage point move. That would help the yield curve, and then they could back off for a while. But I'm not sure they're quite ready, willing, and able to do that. And certainly after Dudley's mildly inflammatory op-ed, things are heated up there a little bit. But I think that as long as we stay away from the trade wars and whatnot, the market can kind of build on itself here. And we'll see. The Fed, I'm assuming it's going to be 25 basis points, and we're still data dependent, and we go from there. So I think the market will express a mild disappointment in that, but there's nothing else I can do. I would be very careful, however. I believe the ECB is going to be meeting before the Fed does. And if they want to do some shock and awe before Ms. Lagarde comes in, that could shape what Powell and the team will have to do then.
I'm glad you brought up the Dudley op-ed. David brought it up yesterday, but a pretty unusual thing where the Fed actually had to respond in a statement that they don't make policy off politics. But the point that the former New York Fed president made, that the Fed essentially would be enabling the president in his trade war and his trade fight to ramp up tariffs and make that kind of trade policy by lowering interest rates in a seemingly pretty strong economy. I mean, do you think that resonates on Wall Street, potentially inside the Fed?
Well, I think he began with an attempt to defend the Fed and try and keep that separation out there. But I think in building his case, he left himself open to not only saying don't operate on the presidential politics, but almost saying don't help this guy get reelected.
Yeah, that last paragraph was a little partisan.
That's what got a lot of people excited. But I think we're past that now. I would keep an eye on the ECB as we get closer to the meeting.